Hello, everyone. Today is Friday, May 13th, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. If it's your first time joining in, welcome. Thanks for being here. My voice is usually not this scratchy and under the weather, but I unfortunately did test positive for COVID earlier this week, and I am recovering from general flu-like symptoms. I'm going to be fine, but really sort of just took me out of really watching the markets and what was already a volatile week, basically monitoring this kind of half time throughout most of this week. So I'm a little bit under the weather. I am going to keep this brief. I had a lot of charts I'd like to show this week, but we're going to just try and get through this. I want to talk about some important points that I was at least noticing out there. So let's dive in. First off, we got our headlines from this week. We got that 30% correction in the Nasdaq 100 that basically rivals what we saw during the COVID initial leg down a couple of years back now at this point, and we've reached that point again. The market did stage a pretty strong reversal Thursday and Friday, and the VIX closed down 5% on the week, despite the fact that the indices, in fact, did close all lower this week by several more percentage points, as you can see here on this right-hand column. So I tweeted about this earlier in the week, but we really didn't get that blow-off VIX excitement that you usually will see in the V-shaped rallies, where everyone is out there full panic mode buying protection. You see the heavy volume come in, and you see just that big wick to mark some type of low. We didn't really get that this week, and I've got some thoughts and some charts I want to talk about in part 2 of this video that sort of maybe illustrates why this time is a little bit different. But importantly, the selling pressure is of similar magnitudes of prior sort of washouts. Now, if we take a look here at our trends from a long-term perspective, obviously there's no change here. Everything from our indicator here, which is our smart trend filters, which is available on our website, is still pointing down and bearish. There's clearly no change to that. Everything closed lower, so that's pretty much as we would expect. One thing that stands out is the dry up in 52-week lows being made this Friday. Now, as I always sort of remind folks, I am using unsettled numbers here, so I don't have the final numbers. This might be a little off, but we've seen just a consecutive series of basically 1,000 new lows being made consecutive day after day after day. And, we certainly saw that pop back up on Friday. So again, signaling that maybe finally we've hit some type of exhaustion point here. You can see the percentage of stocks by Friday session was at 19%, but on Thursday and Wednesday, we had single digits here in the S&P 500 above a 20 SMA. So some pretty washout numbers here in terms of price action for the S&P 500. If we take a look at those 52-week highs minus lows, you can see we just basically have this cascade lower in aggregate here over the past 30 trading sessions. Now, volatility was interesting this week, and this is what I think maybe a lot of people were waiting for, focusing on, me included here, but waiting for some type of real sort of blow off in the VIX. We saw basically the market continue to trade lower day after day this week, without the VIX breaking to really new highs here. Now, the VIX is related to the S&P 500. So that's what we're looking at here. We saw the VIX basically get as high as around 35 this week, which is an extremely elevated level historically. But in terms of this sell-off, it really couldn't get beyond 35. If you were looking at the volatility of the Nasdaq, I think that was around 45, about 10 points higher or so, but you really didn't see it, jump and create some type of panic that we could observe and say, okay, yeah, there's a more targeted, meaningful low. And what we ended up with this week was the VIX actually closing lower on in terms of the volatility term structure than last week. So markets went down, lots more fear out there, stocks getting crushed under the hood, and yet we have the VIX closing below 30 here, 28.81 into the weekend. If we take a look at sector performance, we had most things, as you could imagine, in the red. We had consumer staples, very defensive area of the market, in the green. Otherwise, communication services and healthcare were our second and third spot. Real estate was the drag this week. Consumer discretionary and financials all down almost 4% this week. Interest rates, finally, I guess some good news here. We finally got those yields to back off again. Of course, we are still in a uptrend in yields, so we don't know what this looks like. Is that it? Do we finally just saw the end of the trend here for the time being for interest rates and for yields across the Treasury curve? Well, we'll have to wait and see, but it was certainly a promising week there. Bonds finally starting to actually hedge a portfolio for the first time pretty much all year. If we take a look at dollar and commodities, we saw the dollar index basically rising again. So again, flight to safety, the dollar UUP is the index we're using in this particular table. But this is essentially the only thing that has been providing safety is just getting the good old cold hard cash, or in this case, putting it against a basket of other foreign currencies is basically been the only thing that's been protecting you from the downside this year. We saw gold down, we saw silver down, we saw Bitcoin down 6.5%. That was much lower at mid this week, but 6.5% to finish. Ag ETF was down, but we did see oil, so commodities still staying strong here. Crude oil, natural gas, both up 6 and 10% respectively. Correlations, no real change here, so you can take a pause on this slide. Basically, everything we have been observing over the past couple of weeks, basically risk assets trading together, strong inverse correlations to the dollar and to fixed income. Our trading systems, I'm pretty happy with the performance this week. We basically entered this week 90% cash, 85% cash across everything, and basically stayed that way until the end of the week, where our short-term trading system down here, Lamerick, started to do some buying late in the week, and is currently going into the weekend 40% invested to the long side, and most of those positions coming late in the week. So very happy with that. Our Merlin system here did get stopped out of a couple of remaining positions. It was already coming in pretty light. This 8% here, I believe, is just now gold. So there's no equity positions on, and this is a longer term or intermediate term. I guess it depends on how you want to think about it. About 5-week hold time is how it looks at markets. So right now doesn't want to be involved. Short-term system is looking to capture the potential bounce here that we are basically experiencing right now, and we'll see if we can get that carried through for next week. So both these systems, managing risk as they should. Very happy with the performance year to date. I think it's down about 8% in aggregate here between the two trading systems. And I will take that versus an S&P or a Nasdaq that was, down 2 or 3 times that amount. So managing risk where we should, and we'll see how we finish off the rest of the year. But we do have trials available, $1 trials. If you need some help getting through these markets, take a look at these trading systems, fully automated, fully rules-based. They run without me. I can be sick in bed, and they will perform and act as they should. So that's it for me for part 1. We'll be back here in just a minute with some charts. All right, we are back. We've got TC 2000 open here, and we're looking at the S&P 500 cash settled market. Now, if you recall from last week, we really spent most of our time keeping things very simple and at a high level view. We didn't get too in depth on the short-term swings here about where the market might go over the next couple of days. We really looked at this view here and basically drew these points around 4180 or so, this zone in the S&P 500. And we closed, so again, last week was right here. And so, we talked about the fact that the market tried to get above this support zone, multi-month and year-to-date support. We tried to rally above it last week, and we failed, and we closed pretty much right where we opened, below this zone. And so we essentially said, to be very naive, things look really bad underneath 4180. Below this zone here, things can get ugly, right? This is where bad events are going to happen. And if we can get above it, if we can get back above 4180, if we can get back above 4200 on a daily closing basis, then that's constructive. Then a bounce can happen. Then we can show that there's some commitment here, that buyers are stepping in, and that this support is once again alive to trade against. And until and if that happens, you have to be careful to the downside. Yes, we were stretched and we could bounce at any time, but until and if we start getting back over this zone, you got to be careful, right? That was essentially the elevator pitch for last week's analysis. And I think, if you follow the very simple heuristic there, again, easy in hindsight, but it is what we talked about last week, then you would have saved yourself a lot of grief this week, because certainly bad things happened, right? We fell from the close last week down to the lows here. We had basically another 6.5% down in the S&P 500. Now, that's certainly what happened. We can throw Bollinger Bands on here. You can take a look at the weekly Bollinger Band, right? Weekly Bollinger Band, the market doesn't spend much time above or below these bands on the weekly chart. So you can see big extreme events like COVID, and you can certainly see big extreme tails like this week and a couple of weeks prior this year. But typically, when you start to get really stretched below those levels, the market, tends to come in and eat it up and, bounce us back. So that's what we saw this week. We saw a big move underneath the lower 2 and 20 Bollinger Band on the weekly chart. If you go to the daily chart, you can see again that pretty much occurred here on Wednesday as well. I'm sorry, on Thursday as well, which was the ultimate low all the way down to about 38.58 in the S&P 500. And we saw essentially on Thursday our first close in the upper half of the range that we've seen excuse me, in a few days, or really in the past week or two. And on Friday, we finally got some follow through. So we finally got, on these 2 days here, late in the week, Thursday and Friday, a little bit of change of behavior. We got the close in the top half of the range on Thursday. That was your early signal. So you basically got your peak below the lower Bollinger Band. You got the close in the top half of the range. And then you got your follow through day. You got your gap up, held the gap, and then proceeded to rally here on Friday. So what that does is it at least gives us, at this point, levels to trade against. If you're a short-term trader, now you actually have some levels you can use to manage risk against. We've got the level down here now at 38.58. We can use that and we can manage risk against that. And we can trade against it because we have at least a signal from the market here that some buyers have stepped in. Now, a couple of other, short-term levels, of course, you could use if you want to be, a little bit tighter on your risk. Well, you could use the lows from Friday, right? This gap up. You want to see this gap up hold. You want to see this urgency hold. You want to see this momentum hold. If you are a short-term trader, that is a good level to trade against as well. So maybe you're looking to, participate in this bounce back up to maybe this overhead supply area, maybe around 4180. So maybe we can get a nice rally up into around the 4200 zone and kind of check things out, see what the market feels like up around this area again. You can use the lows here from Friday as your stop, as your get out point, as your place to manage risk, size against, et cetera, et cetera. Again, that's for short-term traders. It's not, the only answer. It's not, I'm not even saying it's perhaps the best answer, but it's a answer, right? It's a way to manage risk. And I think that's what we are always looking for as traders. So we've got the reaction bounce up. We're starting to break these downtrend lines. We are snapping back from oversold levels. If we go to some of the other markets, like the IWM, again, last week we kept things very, very simple. We said about 190 or so, 188. Things get very ugly underneath this area here. If we stay below it, then expect risks to open up to the downside. And if we can get back above it, then that's your signal that you can maybe take a tactical long trade. Bad things certainly happened this week. If we zoom all the way back here, we didn't quite fill this gap, which is a little unfortunate. I'm not a huge, person that's going after all these gaps and everything, but it is always nice when things line up and we do fill gaps over here. So that gap back from 2020 still open, but we did get a nice reactionary bounce here. Again, we got that follow through day, got the heavier volume, and that proceeded to happen here. Same thing with the Qs, basically got a move Thursday and Friday, and we are still, of course, below 319. So the way I'm really looking at this market now is you got to be a trader, right? You got to be managing risk actively here. VIX is still in the upper 20s, so expect volatility in both directions. If you are playing now for a bounce back up to this zone, that's what I'd be paying attention to. Longer term, intermediate term, I still want to see the Qs above 320. I still want to see the Nasdaq 100 above, the S&P 500 above 4,200. Like those are more longer term levels that I just would enjoy seeing the market above. So until and if that happens, got to be in that trader's mindset, got to be a little more nimble, and the primary trend is still down. So let's not forget that. Nice 2-day bounce. Maybe it's the low, but maybe it's not. I want to show you a couple of things here. So we didn't see that VIX blow off. This is a new layout I'm working on. This is actually going to be released as a premium layout on our website. I was intending to get it out this week, but unfortunately that did not happen. So what I want to show here is a lot going on, but this is looking at returns for the Qs right now. We're looking at 21-day rolling returns and five-day rolling returns. We're actually on a weekly chart though, so it's misleading. It's 21 weeks at this point. So 21-week rolling returns, 5-week rolling returns. The reason I bring this up, I'm going to close out some of this other stuff because it's not important right now. I just want to show rolling returns. The reason this is significant here is because, if we look back to the COVID times, right, back in 2020, when the Nasdaq had a 30% correction, take a look at the 21-week rolling returns here. So they are much more negative than they were back here. And so what happened during COVID was first off, the drop was very sudden, took place in 5 weeks. And the difference was we were coming off of a big 2019 and early 2020 start. So we had lots of gains in there that the market basically evaporated. What we have going on currently is a more long and drawn out correction. So I think that's what's painful about this correction this time around is we're not seeing it over in like a week or two. We're not seeing this big V-shaped, let's just correct 20% in a month in 2 weeks and then that's it. It's more long and drawn out. So we started topping out back here in the fourth quarter of last year. Market went sideways, was drifting lower, then it made a leg lower, then it rebounded, and now we're making a second leg lower. So this is just a more extended kind of 6-month correction, and that's why I believe it, sort of feels worse. We didn't get the big VIX capitulation, and I think that's partly related to this. It's because this is taking place over a more steady stream of selling. And if you go under the hood here and you look at individual stocks, particularly growth stocks, tech stocks, you will see the 60 and 70% corrections, and the selling there is quite brutal. And especially this week, if you look at anything in the crypto market or crypto related stocks, all of those, of course, were hammered. We didn't even talk about Terra Luna and the meltdown there, but that's a whole nother story. And the point here, I believe, is just that the selling has been quite intense. It doesn't quite show up, on the VIX, maybe spiking to like 40 or 50, but it is certainly showing in different views like this. You could throw this on like a monthly chart, and it also shows, just some interesting kind of dry up behavior here, where even if you go to the five-month rolling returns now, take a look at the Nasdaq 100 over the past 5 months, and you can see it's now experiencing one of the strongest declines here over a 6-month period, 5-month period, going all the way back to 2008. Now, of course, I'm not trying to build a trading system out of this. I'm not trying to say, okay, this is a reason why you should buy right now, but it's just to show context. It's to show that the market has been experiencing significant selling pressure underneath the market hood and over an extended time horizon. And, the fact that we didn't get the blow off event and the fact that this may not look like a traditional bottom, but it might turn into one, just given the extension of selling that we've seen over the past few months. So that, I think, is the highlight there. That's about as much as my voice can take at this point. So I'm going to leave it there. Hopefully everyone got through this week. It was a tough week, so don't beat yourself up too hard. I think we're all in the same shoes here of feeling the pressure, the weight of these bear markets. They are scary. They are sudden, and they are persistent. So, think about risk management. Think about how you can get better. Don't beat yourself up too hard, and, always try and live to trade another day. Of course, that's the goal. So hopefully you found this helpful. Thanks as always. You can subscribe on our YouTube channel or follow us at The Trade Risk. Have a great week. We'll see you back here next week.